Today, we're talking about a foundational pillar taught in every finance degree that most self-directed investors completely miss: risk tolerance. Hi, everybody. I'm Christos, co-founder of Caplytica, where our goal is to give you the tools and knowledge to turn investing into a shared skill. In this video, I'm going to show you exactly how to calculate your personal risk tolerance, and by the end, you'll know whether your current portfolio is aligned or quietly setting you up to make mistakes most investors don't see until it's too late. Here's something most people don't realize. When you sit down with a good financial advisor, one of the first things that they do is try to figure out your risk profile. They'll ask you personal questions about your income, goals, timeline, how you'd react if the market dropped 20%. Some advisors even use a formal quiz. Why? Because they can't serve you properly without understanding who you are. A portfolio that's perfect for one person could be completely wrong for another. As a self-directed investor, you don't have someone doing this work for you. But here is the good news. You know yourself better than any advisor ever could. The problem is, most of us never actually articulate these things out loud. It's all just floating around in our heads, vague and unexamined. And that's dangerous because your risk tolerance shapes everything about your portfolio. Think about it this way. If you have a low risk tolerance but lofty financial goals, those two things are not compatible. At some point, you'll have to reconcile the difference. Either you become more comfortable with risk or you adjust your expectations. Instead of buying that yacht, maybe it's a canoe, or maybe you decide to add some growth stocks and learn to sleep through the volatility. Either way, you need to know where you actually stand before you can make that choice. That's what this quiz is designed to do. It's the same kind of diagnostic that the professionals use, but you're doing it for yourself. And because you're being honest with yourself, not trying to impress anyone, you'll get a more accurate result than you might from a 30-minute conversation with a stranger in a suit. Okay, it's time for the quiz. I've got it pulled up right here, and I'm going to take it alongside you so you can see how it works. Before we start, a couple of things. This quiz is completely free, and we're not collecting your data. It's just a tool to help you out. The only way to mess this up is to answer how you think you should answer instead of how you actually feel. I've dropped the link in the description so you can do this with me. Otherwise, feel free to skip to the results section right here. All right, let's do it. Question 1. What is your income range? So we've got under 50K, 50 to 100K, 100 to 500K, or over 500K. Pretty straightforward. Just pick where you fall. I'm going to select mine and we'll move on. Question 2, do you have dependents? The more people relying on you financially, the more that factors into how much risk you can realistically take. For me, that's B. When do you expect to use most of your invested money? This is your time horizon, and it's a big one. If you're decades away from needing this money, you've got time to ride out the rough patches. But if you need it soon, say for a down payment on a house in a couple years, you can't afford for the market to tank right when you need to cash out. I'm going with D. How would you describe your investing experience? And be honest. This isn't about ego. If you're new to this, that's totally fine. For me, I'm going to say I'm an experienced investor. How confident are you in your understanding of how markets behave during downturns? This one's related to experience, but it's more about how well you understand what actually happens when markets drop and how long recoveries typically take. If you've never lived through a real downturn, you might not know how you'll react. I'm going to click very confident. How satisfied are you with your current financial situation? This is just a gut check on where you're at today. If you're already stressed about money, adding investment volatility probably isn't going to help. For me, I'm going to go with D. If your portfolio declined 20% during a broad market downturn, how would you feel? Would you be checking your phone every 5 minutes? Would you want to sell everything just to make the anxiety go away? Or would you shrug it off and buy even more? I think I'm putting myself at D. Which statement best describes you? I strongly prefer certainty even if returns are lower. I prefer some stability with limited volatility. I accept volatility in pursuit of higher returns. Or I am comfortable with large swings if expected returns are higher. No judgment on any of these. If you prefer certainty, that's not a flaw, it's just who you are. Own it. I'm going with C. I accept volatility in pursuit of higher returns. A market correction causes one of your investments to drop 14%. What do you do? Here's the thing. Don't answer with what you think the smart investor would do. Answer with what you would actually do, based on how you behaved in the past or how you honestly think you'd react. For me, I'll hold on and wait for it to climb back up. You are offered the following choices. Which do you take? A guaranteed $10,000, a 50% chance at $50,000, a 20% chance at $75,000, or a 5% chance at $100,000. I'm taking B. You invest $100,000. 1 year later, it's worth only $85,000. What matters most in deciding your next step? This reveals how you think under pressure. Are you focused on stopping the pain, or are you zoomed out looking at the bigger picture? I'm picking long-term expected returns. How involved do you want to be in managing your investments? Some people love checking their portfolio every day. Others want to set it up once and not think about it for years. Neither is wrong, but your strategy needs to match your preference. Here at Caplytica, we want to make it possible for everyone to be very active, so we'll pick A. Now, before we get to your results, if you're finding this useful and want more tools like this sent directly to you, this is your chance. When you take the quiz, there's an optional spot to drop your email. We'll send you future resources to help you invest with confidence. No spam, no selling your data, just genuinely useful stuff. If that's not your thing, then no problem at all. Skip it and get to your results. Now for the moment of truth. Based on your answers, you'll fall into one of 5 investor profiles. If you're a conservative investor, your main priority is protecting what you have. You'd rather accept lower, more predictable returns than risk significant losses. Market volatility genuinely stresses you out, and that's not a weakness. It's important self-knowledge. If you're a moderately conservative investor, you're willing to accept some market fluctuation, but you still lean towards safety. You want a bit of growth, but not at the cost of sleepless nights. You're okay with modest ups and downs, but you'd rather not be on a roller coaster. If you're a moderate investor, you're looking for balance. You understand that some risk is necessary for growth, but you're not looking to swing for the fences. You can stomach temporary losses if you believe in the long-term plan, but you can also appreciate having some stability in your portfolio. If you're a moderately aggressive investor, you're comfortable with volatility in pursuit of higher returns. You understand that markets go through rough patches, and you're prepared to ride them out. You're focused on long-term growth and won't panic when your portfolio dips. And if you're an aggressive investor, you have both the emotional grit and the financial runway to take on significant risk. You see the market downturns as buying opportunities, not threats. You're playing the long game, and you're comfortable with substantial swings because you're shooting for substantial growth. Look, there's no best risk profile here. The best profile is the one that's true to who you actually are, because that's the one you'll stick with when things get tough. So you've figured out your risk profile. Now what? Your profile should guide your asset allocation. If you're a conservative investor, your portfolio should prioritize stability above all else. This means something like 80% in bonds and cash with only 20% in stocks. If you're a moderately conservative investor, you want safety with some growth potential. So 60% bonds and 40% stocks gives you market exposure while keeping volatility relatively low. If you're a moderate investor, the classic 60-40 portfolio is your starting point. 60% stocks and 40% bonds. If you're a moderately aggressive investor, you're tilting toward growth. A portfolio of around 75% stocks and 25% bonds puts you in position for stronger long-term returns. And if you're an aggressive investor, your portfolio leans heavily into stocks. Think 90% or more in equities. These percentages are starting points, not rigid rules, but they illustrate the core principle. Your portfolio should be a direct reflection of your personal profile. Finally, you can stop following generic advice and build a plan that is authentically yours. Now that you know your risk profile, you can give your portfolio a tune-up in 2026. In this video right here, I break down 5 ways you can improve your strategy. Click it now, and let's keep this going.